Jason Schwarz, technically speaking, fundamentally speaking, you are not a big fan of stocks right now. Why is that?
Well, we think there's more headwinds facing equities now. We're 6 years into really a raging bull market. Earnings pressure is increasing. We've had strong dollar environment that's hurt a number of companies. But the reality is we're in the latter stages of this epic bull market. And the traditional equity component of an investor's portfolio, we think needs to be intelligently designed to reflect these new realities.
And you suggest that investors who do hold equities, who do like stocks, stick with growth stocks over value stocks. Now, growth has beaten value, I think, for more than a decade now. What makes you so sure we're not going to see the turn in 2016 towards value?
Yeah, no, it's a good question. We still think valuations for growth companies and for growth mutual funds are more attractive than their value counterparts. We think at this stage of the economic cycle, growth companies will continue to do better. We still advocate a balanced and diversified approach, but when we talk about overweights to growth relative to value, we still like that play.
And you like long-short funds as well, so you suggest investors hedge their bets. Good time to own a hedge fund?
Yeah, so
or something like it.
Something like it. I think that the something like it is within the mutual fund space. There's increasing amounts of liquid alternative funds available. Long-short equity strategies still allow investors to get exposure to market beta, so that equity beta, but get increasing levels of downside protection. Should we see bouts of volatility like we saw in August. So gives you the equity exposure that you want in a more flexible way that can provide some absolute return.
And on the bond side, you suggest that investors don't stretch for yield. You say don't get too risky with your bonds. Why not?
Yeah, I mean it's similar to equities. I mean the elements of the bond market are looking increasingly frothy. We're fairly deep into bull market in bonds, and we all acknowledge that it's just a matter of time until rates start to rise. So reaching for yield can be a problem. Fixed income is still an important part of an investor's portfolio, that anchor to windward, the traditional sort of guidepost there that keeps volatility at bay. But reaching for yield can be problematic.
That said, you like high yield better than equity. So a lot of people are worried about high yield right now because spreads are widening. They think if things slow down in 2016, you're going to get a lot more defaults. So you say I guess you're splitting the baby in half.
Yeah, we are to a degree. I mean, high yield we like because it actually pays a yield. So you get equity-like risk, but you're getting paid a yield, to be there. And so, the reality is, when rates start to rise, it's going to require investors to think about their fixed income portions of their portfolios a little bit differently. But we like high yield right now as a replacement to the equity risk, but get paid some yield to be there.
All right. Well, thanks a lot, Jason.
Thanks a lot.
Great stuff. And thank you for watching The Street.